In 2003, a small team in a San Carlos garage decided to prove that electric cars could be more than a niche curiosity. They wanted to build something a billionaire would park next to a Porsche. That goal turned the electric vehicle into a high-tech status symbol, shifting the focus from environmental efficiency to raw desirability. This chart tracks that financial trajectory. By 2024, annual revenue hit $97.7 billion. When we add the volume data, the scale is even clearer. 1.79 million vehicles delivered worldwide in a single year. Contrast that speed with the view from Europe. Legacy giants, like this Volkswagen plant in Germany, are tied to massive industrial footprints and strict regulatory frameworks that make a rapid pivot difficult. Engineering explains how these cars work, but it doesn't explain how the companies behind them grew so large. To understand that, we have to look at the specific financial environment that fueled them. Building a global industrial champion from scratch requires access to risk capital, the private money used to scale unproven ideas. This visualization compares venture capital, or VC, as a percentage of GDP. The United States allocates 0.7% of its economy to these high-risk investments, while the European Union sits at less than half that, between 0.2 and 0.3%. On the ground, an average American startup can tap into roughly $4.9 million in capital to get off the ground. A European startup in the same position generally has to make do with $1.1 million. This gap allows American founders to survive the valley of death, the precarious period between initial research and actually getting a product to market. European innovators often stall not because they lack talent, but because the local financial ecosystem provides a trickle of cash where competitors have a flood. While private investors provide the initial spark, the federal government eventually steps in with a much larger financial flame. In 2022, the U.S. government passed the Inflation Reduction Act. It is an aggressive industrial strategy disguised as an inflation bill designed to incentivize clean tech manufacturing on American soil. This map shows the results. Federal subsidies triggered $188 billion in private investment across 185 sites in under 3 years. This influx has already translated into 194,000 announced jobs directly linked to the electric vehicle transition. This is the use of massive public spending to buy industrial dominance and secure critical supply chains against foreign competitors. But as history has shown time and time again, even a massive, heavily funded financial machine eventually meets a sudden and unavoidable limit. This graph tracks global deliveries into 2025. After a decade of consistent expansion, the line suddenly breaks, showing deliveries dropped by 8.6% to 1.636 million vehicles. The shift occurred because the American champion was suddenly facing a rival with a different set of advantages. China's BYD officially pulled ahead in 2025, moving the center of the automotive world toward Beijing. We are now seeing the limits of the market-driven American model when it faces the decades of meticulous, state-led planning that China used to build its battery industry. Europe remains stuck in the middle. Without the American venture capital pool or Chinese state coordination, its legacy factories are left to navigate a global market they no longer control. A national treasury can build a manufacturing surge, but it cannot guarantee the future will belong to the highest bidder.